Good morning, good afternoon, good evening, and welcome to our 313th weekly webcast. Now, if this is the first time you're joining us, welcome. If you've been with us before, welcome back. Now, the way this call works is this is an AMA, like you see on Reddit, meaning ask me anything. You can ask me business questions, career questions, startup questions, investing questions, any questions you have. And my humble goal here is to help you take your career to the next level. So let's kick it off with Tabo, who wrote, "Hi, Chris. Hope you're doing well. Great to see you. When making a financial model, how could one approach the issue of changes in details in the financial statements over many periods?" Yeah. So when you make a financial model, it's a lot easier than you think. All you're going to do, mainly to start, is you're going to forecast revenue, okay, which is the top of the income statement. That's why they call it the top line. And once you spend most of your time on revenue, okay, so if a company has decent revenue growth, everything else is taken care of. So once you forecast revenue over the next 5 or 10 years or so, based on analyzing historicals, then what you're going to do is you're going to forecast most of these red items, meaning expense line items, as a percent of revenue and look for patterns in the data. So for example, if research and development is usually 10% of revenue and every year historically it goes down by 0.5%, then model a decrease of 0.5% every year within reason, obviously. That's all you need to do. Now, when it comes to one-off events, so when I create financial models analyzing historical data, and I try to go as far back as I possibly can, there are certain years I ignore, okay, because those years are black swan events, so to speak. And so, for example, 2001 I ignore because of 9/11. That was a black swan or a random event. I also ignore 2008 because of the financial crisis where we were within 24 hours of bank machines not working. 2 more years I ignore. One of them is 2020, especially the beginning of 2020, given the COVID crisis. And then many years from now, when I start creating financial statements, I'm going to ignore this year as well, especially the first 6 months of 2025, because you have events that you just can't forecast. There's not going to be a trade war every single year. There's not going to be 9/11 every single year. There's not going to be COVID every single year. And so what you're trying to do is you're trying to normalize for growth, okay? By the same token, when you look at historical revenue growth and you're forecasting companies, if you see a big spike one year to the next in revenue because a company made an acquisition, then you want to certainly not model the same toward growth every year because that's non-organic growth. If you have additional questions, please let me know and thank you. But use as much historical data as you can. I recommend going to sec.gov, reading the 10K, as well as the quarterly reports, etc. If a company just went public in the past 20 years, like Meta did in 2012, you certainly want to use their S1 document as well. There's a lot of great historical financial data, as well as a lot of risks that are mentioned here by lawyers and investment bankers. Okay. All right, if you have follow-ups, let me know, please. Next question is, what's your take on gold ETFs? Are they worth holding, even though they do not pay dividends compared to just holding a commodity, for example, XAUSD? Yeah. So I'm a huge fan of gold ETFs. I own it in my portfolio. I always do. Do your research first. The best gold ETF to invest in, for me, even though there are fees, is GLD. So let's go together. Okay, don't pay for any research websites online. Don't take anybody's advice either on stocks. Type GLD. Okay, so this was launched back in 2004. And if you want to invest in gold, the fees here are 40 cents per $100 you invest per year. That's not bad. And the great thing about this is that you know it's real gold and it's very liquid. It trades an average daily volume of 10 million shares. You can get in and out quickly if need be. I recommend being a long-term investor as always though. The problem with buying gold from traditional places, like downtown in certain markets in certain cities, is you don't know if it's real or not. And that's an issue. It could be watered down. It could be plastic like this. It could be fake, like I'm a fake teacher. That sort of thing. But anyway, that's why I love investing in ETFs, gold ETFs especially. And gold is, you want to invest in asset classes where there's a dearth, meaning a limit of supply. You know, my grandfather, God bless him, used to always say to me, "Chrissy, buy land, they're not making it anymore." And the great thing about gold is that there is a dearth, meaning scarcity of supply. Now, gold tends to go up in times of uncertainty. Okay, it's a fear asset, so to speak. And so back in 2008, when we were within 24 hours of bank machines not working, when I ran my hedge fund, my biggest long position was gold, ticker GLD, that ticker right there. Be long-term focused. I promise it will serve you well. Now, I want to talk about crypto ETFs really quickly because I do get a lot of questions on this. So one of the reasons cryptocurrencies have seen torrid growth, especially Bitcoin, in the past 4 years or so, is because the SEC blessed, meaning they're allowing companies to create Bitcoin ETFs and crypto ETFs. Now, the old way or the current way of buying cryptos is you have to get a token called a Ledger Nano, and there's many others as well, like the Trezor, etc. And then what you do is you set up this wallet. It's a cold storage wallet. You plug it into your USB port in your computer. And then you have to answer a gazillion questions. And it's so complicated to set these things up. So when you're about to buy your first cryptocurrency, you're like, dude, I'm so confused. I'm going to cut my order in half. Well, because there are ETFs now for Bitcoin and other cryptocurrencies, people aren't as fearful in terms of being confused when they're buying that asset class, commensurate with what happened with gold back in 2004 with their ETF. And that's one of the reasons why Bitcoin and ETFs or cryptocurrency have been doing quite well over the past couple of years as well. Plus, you have an administration, the Trump administration, that is very pro cryptocurrency and pro Bitcoin. In fact, the new head of the Securities and Exchange Commission was a lobbyist with cryptos before he took this position. Let me move on to the next question. What could an analyst do when the company's breakdown of revenues and drivers changes over periods? For example, Tesla. Their breakdown of vehicle deliveries has changed over the last few years. Yeah. So what you want to do is you always want to look at historical patterns, but you certainly want to ignore one-off years, right? So if deliveries, hypothetically speaking, for Teslas will be down 30% this year because of Elon Musk's cooperation with Doge, etc., you don't want to model that down 30% every year. Otherwise, the company won't exist in a couple of years. You want to normalize for that one-time loss. Now, when it comes to Elon Musk and any company you want to invest in, I like to invest when the founder or one of the earlier employees like Elon Musk is still 100% committed to running that fund, okay, or that firm. Whenever a founder, okay, takes their eye off the ball, meaning they buy a sports team or something, or they buy a company like X, or they get involved in Doge, it's usually a short. Okay, now, when I used to work in the hedge fund industry, when the founder of a company bought a sports team, it might be one factor why we look to short the stock because they're not clearly all in. Now, when it came to Elon Musk buying Twitter, Tesla stock got murdered because of it. Execution fell off a cliff. And the same thing is happening right now with Tesla. So I think, I don't know anything, but Trump has kind of hinted that Elon Musk is going to step down from Doge within a couple of months or so. And if the stock is materially oversold at that point, I might be buying. Yeah. So the bottom line is never invest in a company when the founder is not all in. And when a founder leaves a company, I don't invest. 99% of the time, it's a loser investment, especially in the tech sector. Yes, there are exceptions. All right, next question I've got here is, would you recommend holding covered calls, premium income ETFs, such as yield max ETFs for the long run due to their high dividend yield but limited upside? You got to be careful with that. The reason I say that is whenever you look at the dividend yield on any ETF, you have to double check that it's sustainable. Sometimes you might see a highly leveraged ETF with options instruments in it that has a 20% yield. But that just might be a one-time event. You have to look at the average yield over time. And I don't want anybody to sell options because what happens when you sell calls and puts is you run the risk of being randomly assigned. And what that means basically is you end up owing a lot more money than you invested. And I can go into more details if you'd like me to. Thank you. All right, next question is, in what order do you read SEC documents? Yeah, so the Securities and Exchange Commission was created in the 1930s by the United States government, and it oversees the U.S. markets. And whenever you look to invest in a company, I always want you to go to the source where the financial instruments came from. Okay, don't go to Yahoo Finance to look at the income statement, etc. Let me show you how it's done very quickly, and then I'll talk about the order. Okay, so let's go together to sec.gov. Okay. And let's type in the ticker of a company, Apple in this case. So the first thing you want to do, if a company went public in the past 20 years, you'll be able to find the S1 document here. Apple went public many, many years ago, so you won't be able to find it here. So step one, you're going to look at the annual report. Okay. Step two, and this is released annually, of course. Step two, you're going to look at the quarterly reports, which are released 3 times per year, not 4 times because the quarterlies are in the 10K. You're going to build out your financial model. Then step 4, what you're going to do is you're going to read every single 8K. Now, an 8K is an important press release with material information usually. So every 3 months when a company reports earnings, they release an 8K, which is a press release. I want you to read those as well as you update your financial model. Now, as you look through the annual report, I want you to read every single line item. And if you don't understand something, just ask me, please. But I want you to pay special attention to the financial statements, okay? All the financial statements, and this will help you update your model. More importantly, though, I want you to pay attention to what are called the footnotes. Now, most people don't know much about this stuff. I'm creating an elective course for my MBA degree program students, which is coming out very soon. So when you analyze footnotes, when companies release their 10K, just like with a book or an article, there's footnotes for more details. There's tons of footnotes that are beside the 3 major financial statements. And so in this elective course that my MBA degree program students are going to get, if you're interested, take a look at the link in the description of this video, set up a call with us. But in this course here, I analyze every single one of the footnotes and I explain it to you from scratch. Then I create a massive executive summary and a massive detailed report for you as well. Now, whenever you're analyzing companies, don't rely on me, that's right, or anybody on television that speaks gooder than me, or anybody at all to tell you what to buy. I want you to do your own financial research. And in my MBA degree programs on my website, exclusively, what I have are templates like this, where you can analyze companies based on my work experience at the biggest hedge funds, working at Goldman, venture capital, etc. So there's 100 steps to analyze a company. You always start with the management team. They don't teach you that in business school. You're going to answer the questions here. Okay, I ask you 700 or 800 questions. Then you look at the company history, the products, the catalysts, the drivers, etc. And then you look at the quantitative information. Okay, and without data to analyze, you have an opinion and not an investment thesis. So what you're going to do is you start with the total addressable market, market growth, etc. And all this feeds directly into your financial statements down here, where you build out your income statement, balance sheet, cash flow statement, and come up with target price, etc. Now, the importance of doing this, and I've helped many of my students get jobs at the top investment banks, hedge funds, venture capital firms, private equity firms with this methodology. The good thing about doing this is this. What I create for you, and this is dummy data, is a 1-page report. Okay, what comes out of this. And what you're going to do is you're going to print this and put this on the back of your resume for your informational meetings, or send it to people that you're interviewing with as a follow-up. What also comes out of this is a massive 100+ page due diligence report and a nice dashboard as well that you can bring to your informational meetings as well based on the data that you entered in. Always do your own research yourself. Again, do not rely on anybody else to tell you what stocks to buy, including me. I give you all the templates so you can work smarter and not harder. Instead of humbly providing you with a fish, I teach you how to fish so you can eat for a lifetime. Okay. All right. All right, next question is, how is valuation made? Do you estimate earnings per share on the 5th year, use some reasonable multiple to discount to present value, and do you compare with the current price? Absolutely. Yes, there's 3 ways to value stocks. Okay, there's many people use. There's discounted cash flow, which I can go into in a lot more detail if you want me to. Basically what that means is take all the cash the company makes in the future, discount it today. There's price to revenue, which means for every $1 in revenue, how many dollars are you paying for that $1 in revenue price-wise? And you do that if a company's not profitable. But my favorite one, the one you mentioned, is PE. So the way I look at it is this, and I have all the templates for you guys to do this as well. You forecast your income statement, okay, and you do it on a cash basis. What does that mean? Well, you ignore non-cash crap like depreciation, amortization, stock-based compensation, etc. So what you're going to do is you're going to forecast revenue and then calculate these expenses, usually as a percent of revenue for most of them. Then that's going to get you net income. Net income, profits, earnings, same thing. Then you take net income, okay, and you're going to divide it by the number of shares, and that's your earnings per share. Now, I never like to invest in companies based on this year's earnings or last year's earnings or next year's earnings forecast, because everybody does that. Plus, I'm a very long-term investor. If all you did was focus on the P multiple of your favorite stocks today, you wouldn't buy them because they're at like 100 times earnings, especially for growth stocks. So what I like to do is I like to forecast my income statement out 5 years. So I get net income in 5 years. Then what I do is I apply a target price based on what I think the PE should be then. So what should the PE be then? Well, a price earnings multiple, and the way it works is PE, and for the rest of your life, whenever you see a formula, think of the denominator being the number 1. So a PE of 10 means for every $1 in earnings per share, investors are paying 10 times that $1. Why would an investor pay 20 times that $1? Well, if the company is growing faster. So a simplistic way to look at it is this. Let's say we forecast our earnings 5 years out, okay? And we have, let's just say, $1 in earnings in year 5. And that $1 is growing earnings between year 4 and 5 of 20%. So that means we're going to conservatively put a price target of 20 times that $1, okay? So that's a price earnings growth rate of 1, okay? It's a very conservative way to do it. And that's what your target price is going to be 5 years from now. You don't need to discount to today's terms if you're going to hold it for 5 years and you see material upside. Otherwise, you can use the 10-year treasury or take a number like a 4 or 5% discount to today, kind of like you do with discounted cash flow, which I can talk about as well. Now, a lot of hedge funds, what they do is they short a stock that is too expensive on a PE basis and vice versa. Let me explain that. So historically, the S&P 500 trades at around 15 times earnings. And historically, the S&P 500 has earnings growth of about 15%, roughly. So a P of 15 divided by growth of 15% is 1. That's a price earnings to growth rate of 1. So if a company in the S&P 500 has earnings growing at 40%, it's going to trade at a much higher multiple, okay? And if you see a stock that is trading at a price earnings to growth rate of 2 times based on your forecast, it could be overvalued and a potential short candidate, or you can buy puts, which I explain in my MBA degree program. Okay, so hopefully that makes sense. Yeah. And if you have follow-ups, as always, please let me know. All right, next question I've got is from Peter. Hey, Peter. Peter wrote, did you ever have to do double entry bookkeeping? I'm doing an intro course on debits and credits, and they're a lot more complicated than you think compared to simple bank statements. Yeah. The worst way to learn accounting and finance is debits and credits. It's an old school way of looking at T accounts, okay? Don't go there. The way I teach it, and Peter, you're in my MBA degree program, watch the 100 or 200 hours worth of finance and accounting lessons in there. The way I do it is I teach you how the world works, okay? I teach you how to forecast based on how real analysts do it, yeah. And whenever you're thinking about financial statements, I want you to thoroughly understand numbers and formulas and rearrange them. And why is it called a balance sheet? Well, because your assets has to equal liabilities plus equity. It's just the way I teach with props. It's fun this way. Eh? Then what I want you to do is just rearrange these formulas to see if it makes sense. Really understand this stuff. Otherwise, what will happen is you'll get a D in accounting like I did in 1990 at McGill University when I was maybe doing too much of this. Because I memorized it, I didn't understand. Then I took it again and I got a little bit better in a D. All right. Next question is, which of these companies are in their decline already, according to you? Nvidia, Mercado Libre, which is in Brazil, I think, C Limited, Palantir, Costco, AppLovin, Cloudflare, Shopify, Twilio, Datadog, and Zoom Communications and Netflix. Yeah. So the question I have for you is this, a couple things, okay? And I'm going to help you think through this. And whenever you analyze a company like this, what I recommend that you do is you write a full due diligence report using this framework right here. But what I recommend doing is step 1, look at the management team. Are you confident in the management team? Is the founder still running the company? Yes or no? Is Reed Hastings really involved with Netflix still? That sort of thing. Is Jeff Bezos really involved with Amazon anymore? If not, that's a risk in my humble opinion. Then you have to ask yourself this. In 5 years, will this company and the sector it's in be more relevant or less relevant than it is today? For example, will people be doing more Zoom calls in 5 years than today? I think so. Is the founder still running Zoom? You'll have to look into it. Now, there's so many other factors as well you have to look at. Okay, you got to look at valuation fundamentals, and a distant third is technical analysis in terms of helping you to get an entry point. So that's some thoughts for you. If you want, do the research based on that. I do like Nvidia. Okay, do your research first, because Jensen Huang, who I think is the best CEO on the planet right now, is running the company. He's the founder. Whenever a founder leaves a company, I run for the exits. Yeah. Okay. All right, next question. And Palantir, I invested in Palantir and Facebook when I worked in venture capital pre-IPO, so I know those companies quite well. When it comes to Palantir, I think AI-based software is going to be more relevant in 5 years than it is today. And there's plenty of risk with Palantir. I can go there as well. Now, Palantir, for those who are not familiar with it, is what the Obama administration used to find Osama bin Laden. Without Palantir, they would not have found him as quickly as they did. And what Palantir does from an AI perspective is analyze a lot of data, finds a pattern, and helps you find solutions. A lot of big banks use it for cybersecurity reasons. A lot of governments use it for security reasons as well, also for human trafficking reasons and many other reasons as well. The issue with Palantir is that it's not your traditional enterprise software company, because it's a very manual process. You need a lot of people on site to feed data in. It's getting better though now, but that's why I don't think that profit margins on Palantir, based on my forecast, will ever be as good as Oracle unless they change their business model a bit. But I do like the CEO. And when you shake his hand, it hurts, man. He squeezes so hard. All right. Next question is, I have some positions in my portfolio that already lost 50%. I'm sorry to hear that. Provided that I already made the mistake of buying them, what do I do now? It seems like I can't accept it, or I wait and it gets worse. And if people don't have time to do, I say this with all my heart, deep due diligence, just buy ETFs, okay? Especially the ticker VOO, for example. Okay, that's the S&P 500 ETF, where I put my money when I'm not sure where to put it. Do your research first. So when it comes to portfolio management and risk management, I never want my students or my clients to have more than 20 stocks in your portfolio. And I don't want any stock to be more than 5% of your portfolio. And that's just good risk management. And I don't care if a company has a cure for cancer. It can't be more than 5% of your portfolio. And I also don't want you to have more than 20% of your portfolio in any one particular sector. For example, technology, retail, industrial, cyclicals, commodities, etc. And I don't want you to have too much exposure to the United States if you live outside the United States, because you got dollar exposure there as well. Now, in terms of what do you do with these positions that are down? I would write these research reports using that template I showed you as fast as you can. And if you want me to help you with that, I'm more than happy to. Now, in my MBA degree programs, what I do, and this is new for a lot of you, what I do is I have daily, very small group Zoom calls every single day. Okay, so that's 350 hours of group Zoom calls over the course of 1 year. Plus you get 500 hours of my MBA degree programs content included. That's only available on my website. To learn more, go to harounmba.com and then just go to product services, MBA degrees, and you can read more right here. Now with my MBA degree programs, you get the 500 hours. Okay, and I don't believe in government accreditation. Okay, I found the stuff I learned in business school was BS. It didn't help me with my career. So I teach you practical, not theoretical stuff. I'm not an MBA degree mill here, okay? I'm here to teach you business. I teach you everything about business. So what's included here is, and I'll wrap this up quickly, I promise you. What's included here is 500 hours of my content you get online. It's like watching Netflix on my website. You have lifetime access to that, including all new electives. And what's included in this version here is you get 3 hours of one-on-ones with me. And this one, you get 10 hours of one-on-ones with me, Mondays through Saturdays. And these programs, as I mentioned earlier, also include 350 hours of daily, very small group Zoom calls with myself, nobody else, with me, over the course of a year. So every weekday, you get calls with me. If you're interested, just click book a meeting at the bottom of this page, which I'm kind of covering under one of my arms here. Okay. All right, let me go back. If you have questions on that or anything, let me know too, please. All right, moving on to the next question here is, can I divide my budget for stocks in half? Half it goes to growth, half to value stocks. It depends on your age. Okay, so there's an old private wealth management school of thought, which is this. You take 100 minus your age, and that will tell you how much risk you can take on in your portfolio. So if you're 20 years old, 100 minus 20 is 80. That means 80% of your portfolio can be in slightly riskier growth stocks and maybe 20% in lower risk stocks or value stocks or AAA rated bonds, etc. By the same token, if you're 75 years old, 100 minus 75 is 25. And what that means is 25% of your investments can be in growth or slightly riskier stocks or by the Qs, meaning NASDAQ, tech stocks in NASDAQ. And 75% should be in very low risk value investments, the stuff that Warren Buffett buys with decent dividend yields, with good cash flow, or bonds as well. And the reason why is because you have less time to make it up, right? You don't have as many years left to live. The reason I say that's old school is because I really do believe that a lot of people on this call will make it to 150. In fact, the average life expectancy today is 26 years longer than it was back in the 1950s. So whatever your age is, I'm 53. 53 minus 26 is 27. So that's your age, and that's how you think about it. And I don't care how young or old you guys are. If you want to start over, start a new career, you can do it. And the best way to do it, to be able to get a new job or get customers, okay, is to network aggressively. Your network is your net worth. I teach this in my MBA degree programs. If you want to get this book for free, just go to my website, harounmba.com. It's at the very bottom. Okay, let me move on to the next question. Next question is, if you don't live in the United States, what geographical distribution of stocks makes sense? You wrote 40% US, 30% Europe, 10% India, 10% Japan, and then 10% Brazil. Yeah. Yeah. So I would think that closer to 40% is fair to invest in the US markets only because of this. I know times are scary right now, but things are never as bad as you think. I promise you. And by the way, when the VIX hits 70, if it does, I'm buying tons of stocks. I don't care if it feels like the end of the world. And I guarantee you, and I put my reputation on the line, we will make money together that way. But the reason why I think that having close to 40% in US assets, if you're overseas, makes sense, is because investing is relative. And the very last company on the planet, so to speak, that would ever go bankrupt is the US government. It is what it is. So investing is all relative. And if you're in the United States, of course, you can have much, much more as a percent of your net worth in the US markets as well, because your exposure is to dollars anyway, where you live. And I can talk about that in more detail if you want me to. In terms of Europe, I think having a healthy exposure to Europe makes sense. All first world countries, very well run, capitalist. Okay. India, absolutely biggest democracy in the world. I love India. Japan, Japan is kind of in value territory right now. What breaks my heart with Japan is that the population in Japan right now is 130 million. And it's going down to 80 million in a couple of decades. Very, very sad. But a lot of value investors like Buffett are looking at Japan like right now. Brazil is decent as well. If you want to buy Brazil, buy the ticker EWZ, or EWZ as we say in Canada. That's the ETF for Brazil. It's a natural resources rich economy. So as oil prices go up and other commodity prices in general, so too will the Brazilian real and the EWZ. The biggest risk is always policy risk. Like Lula is president again. I don't mind him actually. Okay, next question is, would you buy alternatives to the S&P 500? For example, Brazil's S&P 500. I think Brazil's a great investment. So Brazil right now is where America was back in the 1960s. So back in the 1960s, this is good from an investing perspective. Okay, I'm not commenting on the people of Brazil at all, but hear me out. So in the 1960s in America, a lot of great infrastructure stocks like airlines were wonderful growth stocks. And that's the way Brazil is right now. I think of it being in the late 1960s, America-wise. Okay. Now, if you want to buy Brazil or invest in Brazil, I'll show you the easiest way. And this is what I used to do. So let's go together again to finance.yahoo.com and let's type up the ETF. And I'm going to show you a great website in a second for ETFs. You're going to love this. It's free. Okay. But the EWZ. All right. So this here is a way to invest in Brazil's S&P 500, sort of, right? Brazil's index. Now, because it's less liquid than the S&P 500, right? In general, it's on a dollar basis. It's the expense ratio is higher at 0.59%. What that means is for every $100 you invest, you're going to pay 59 cents per year in fees, which is nothing compared to mutual funds, which have 500 pennies per year. That's right, with hidden fees. Now, what you always want to do is you want to look at the volume. And you never want to buy more than 10% of the volume in any stock. You want that to be a maximum position or ETF. And the reason I say that is because illiquid stocks own you in a down market and not vice versa. You also want to go here to the holdings. Okay, so as I mentioned, Brazil is a very natural resources rich economy. So a lot of these stocks here are natural resources based. For example, Petrobras, which is petroleum Brazil. Okay, and let me show you now a very good website so you can do research on ETFs for free. So this is a website here called ETFDB. That's ETF database, etfdb.com. And what you can do here is you can screen by any type of ETF you want. There's 5,000 ETFs. So ETF by geography. So if you want to get exposure to Argentina, Brazil, etc., you can click here to look at all of the funds here. Okay, and EWZ is one of these here. What you can also do here is if you want to invest in a certain type of ETF, like real estate, China, which I'm not a fan of investing wise. I can go there if you want me to. Or healthcare, or gaming, or lithium, for example, you can always invest in these here. Now, when you click here on them, you can always find what the fees are as well as the holdings. We lost a bunch of people there. I'm going to move on to the next question. It's fun doing these things live. Okay. Okay, next question. Is a CAGR, meaning compound annual growth rate, of 15% good enough? Or do we have to search for better ones? Yeah, I would focus more so on profitability. Yeah, so you want to make sure that in the long run, if you have a CAGR of 15% for revenue growth, meaning top line growth, that your earnings in the long run are going to be growing faster than revenue. And I don't mind investing in a company that's growing revenue very fast right now and has massive expenses, so they're not profitable. I'm cool with that. It's a growth stock, as long as they can be profitable in 5 years or so. And so when I worked in the hedge fund industry, I remember I owned Amazon. I was long. And a lot of people, when I went to these hedge fund conferences at hotels in New York City, San Francisco, etc., they would say to me, Chris, you're crazy. You own Amazon as a long. You're nuts. It's 100 times earnings. That's a widow maker. And I would say, no. It's actually 3 times my earnings estimates in 5 or 10 years. That's how you have to think. You have to think long term. And a lot of people think that the best hedge funds are day traders. They're not. They're actually longer term investors. Now, a lot of the best hedge funds, they think 3 years out. They might trade around positions, but they're longer term focused. And never, ever, ever day trade, please. I'm going to get down on my knees. I do this every now and then because I have love in my heart and I care deeply about my students. Here I go. All right. When you get older, it hurts to kneel, man. Okay. Please, 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 please don't ever, 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 ever day trade. You will lose all your money. There's a reason why there's no successful day traders that we can mention. They don't exist. The problem is this, okay? So stocks go up and down in a short amount of time for random reasons. I can't predict what the heck Trump is going to say next. I have no idea. And so what happens is black swan events occur that you can't forecast. So a black swan is and this is a great book by Taleb, please read it. But black swans are very rare. You don't really see them very much, hence the term black swan, unless you live in Tasmania. But black swan events are stuff you can't forecast, like 9/11. Nobody knew. COVID. Nobody knew. Tariffs. Nobody knew. We don't know what Trump is going to say next. And the problem is this. If you day trade or you're short-term focused, you're going to lose money. It's like going to a casino. Please don't go to a casino when you invest, right? You work hard for your money. I want you to be very, very long-term focused. You know, Warren Buffett, whenever he buys a stock, like when he bought Coca-Cola around 1990, which he still owns today, he's so long-term focused, he tells himself, I don't care if the market's closed for 10 years. That's how long-term focused he is. And we've all made the cardinal sin of selling our favorite stocks because they went down. And Warren Buffett once said that the New York Stock Exchange is the only store in the world where consumers sell stuff when it goes on sale. It's ludicrous. We've all owned stocks where we bought it here. The chart looks like this. It went down a bit there and we got scared, so we sold. And today the stock is much, much higher. I want you all to focus on the destination, meaning your target price, which I can help you calculate, and not the path. You'll sleep better at night. For example, your house. A lot of people own houses or apartments. It's the best investment you can make. Imagine if you could freak out and sell your house right away if it was liquid. You'd be screwed because your house is going to be worth an insane amount more in the long run. I want you all to be long-term focused. Please. Things are never as bad as they seem, and things are also never as good as they seem. Just be patient. Be patient, okay? If your favorite stocks are getting murdered right now, and you see 300% upside in 5 years, whatever, start buying. Be a contrarian and watch your net worth take off. You know, I got to use, as a very proud Canadian, even more proud, so proud these days, Wayne Gretzky was very successful. Not because he skates where the puck is, but rather because he skates where the puck is going to be. By the same token, I want you to focus on where stocks are going to be target price-wise in 5 or 10 years. I want you to buy stocks that people are going to like. And that's why I really love when you start looking at investing in stocks, you ask yourself this question: in 5 years, is this company going to be more relevant or less relevant than it is today? And people are freaking out about the markets right now, and it breaks my heart. And if you think about it, the market is still where it was in 2024. Will we get these tariffs resolved? I promise you we will. Faster than you think. Okay? Japan is already in late stage talks with the United States to lower tariffs. Okay, I'm not saying that this is the right call by the Trump administration. He could have done it in slower increments over time. But Donald Trump, love him or hate him, okay? I'm going to call a spade a spade. He can get a deal done. Okay, have faith. Now, when two people negotiate, one party usually says, I want this. The other party says, I want this. With Trump, it's different. One party says, I want this, and the other party says, and Trump says, I want this. It's off the screen. And then instead of meeting here, they might meet a little bit here. Okay? I think that longer term, it makes sense what he's doing. I wish it was done slowly over time without bullying. But if you think about it, it makes sense. So he's thinking very, very long term, okay, with U.S. economy. Let's be objective. I don't care if you're a Democrat, Republican, Independent, okay? And I'm a libertarian, and I did not vote in the last election, by the way. So if you think long term, what's going on with the U.S. economy? Well, the United States has $36 trillion in debt. It's going to matter at some point, right? At some point it will. It's getting out of hand. So how do you restructure an economy? Okay, America is a turnaround right now. Well, two things you can do. Okay, think of America as being a stock. Okay, how do you make net income better? Well, you can do two things. You can grow revenue, which is what he's thinking longer term with tariffs, right? So he can sell more stuff to other countries. Yes, it's painful now. That's one thing you can do. Or you can cut expenses, and that's what he's doing right now with Doge. Okay, now, when I disagree with the amount of cuts he's doing, especially with the State Department, because a lot of these programs, as silly as they sound overseas, that America is paying for, were set by the Kennedy administration, other administrations, with one goal in mind that nobody talks about, which is this: fight communism, embrace democracy. That's crucial. And China's got a lot of influence now. Now, when I go to Rwanda and Kenya, and I build my schools there, and as many of you know, I'm building 1,000 schools with the profits from what I do. I'm going to die broke. But whenever I go there, I see beautifully paved roads by the Chinese, right? The infrastructure that they're developing there is unbelievable. They're taking out all the natural resources from the DRC in the middle of the Congo, in the middle of Africa, to help China grow. But what they're also doing, I think, is they're having some sort of an influence when it comes to geopolitics in terms of where people lie in some countries on the political spectrum, meaning more left-wing, right? Meaning communism, which is filth. That's right. And there's a reason why, like even I look at the South Africa, I have a lot of students in South Africa. I love South Africa, but it's starting to lean a little bit more towards a command-based economy as well. So China's having a lot of influence in the world right now. And that's scary. That's scary. I believe in freedom of the individual. Now, my biggest fear about what's happening right now, and I do believe that things are going to be better than we think in 6 to 12 months, I promise you. I think so. But what scares me is this. When you had a tariff war in the 1930s, that led to World War II. Okay? Whenever there's a lot of economic uncertainty globally, the threat of war is higher. It's terrifying. And the United States is signaling we'd like Greenland. So does that mean it's okay for other countries to say we'd like other places as well, places that rhyme with Raiwan? But all jokes aside, I do worry about things escalating, and I always pray for peace. Yeah. And we will get through this. Yeah. And on TikTok, I don't know if you guys have seen. I use TikTok a lot. I love it. It's fun. It's how I fall asleep at night. But there's a lot of videos that are being posted now that are, I don't want to say the word propaganda, but I want to say influential in a certain way I'm not comfortable with. The bottom line is, I hope we resolve this quickly. I think we will. I think Trump will get a deal done. I'm the eternal optimist. My glass is never half full. It's never half empty, of course. My cup overfloweth with optimism. Stay positive. Think very, very long term. Okay. I try not to talk about politics, but I had to. All right. Next question is the valuation methodology that I spoke about available in individual courses as well, or only in the MBA? What about the real estate course? Yeah. So it's in my MBA degree program. Yeah. So, but let me show you here. And my real estate course is only available in my MBA degree program. So here's what it looks like. And I want all of you to buy real estate, please. Okay. And I know it's tough. You can't do it right away. It takes time. For me, I couldn't buy my first apartment in New York until my 30s. And by the way, I bought right after 9/11. Why? Because everybody was freaking out. And people thought, Chris, you're crazy to buy an apartment. That's when you buy it. That's kind of like when you buy stocks too. But my dream is for all of my students within 10 to 15 years to make more money from the real estate investment properties than they do from their base salary. The wealthiest people in America buy real estate. You rent them out. You get incredible tax breaks. You can use depreciation to make your taxes way, way lower as well. And so in this course here, and this works in every country in the world, you enter in the address of where you want to buy. I teach you everything. I value real estate 5 ways. And what comes out of it is a 1-page executive summary, as well as a massive, massive business plan. And I really do believe that failing to plan is planning to fail. And so before you invest in any stock, I want you to complete a template I provide you with. Before you start any company, I want you to create a business plan. I provide you with that as well. Again, failing to plan is plan to fail. And before you buy real estate, I want you to complete my course, okay? And out of it will come a 27-page due diligence report that will teach you everything, almost everything about real estate, so you can plan before wasting your money. Yeah. All right. One more thing about real estate. So, okay, I'm going to politics again, okay? So back in 2016, when Hillary Clinton and Donald Trump had that first very controversial debate, Hillary Clinton said to Donald Trump, okay, you're not paying taxes. And she hinted that he's unethical, okay, in that respect. And his response was this: well, I own real estate. I get to use depreciation. And that's why the wealthiest people in the world, they own tons of real estate. And the wealthiest people in the world, they pay less in taxes. It's not fair, but it is what it is. And the reason why they pay less in taxes is because right here, there's a big expense item called depreciation, which makes the amount of tax they pay much, much less. Now, the 400 richest families in America only pay about 20% in taxes per year. It's not fair. And even back in 2000, and I want you all to start your own companies so you can legally pay less in taxes, okay? And I'll help you do it as well. But back in 2007, when Jeff Bezos was already a billionaire many times over, not only did he not pay tax that year, but he actually got $16,000 back from the United States government because of his 4 kids. He got $4,000 each. I have 3 kids. Yeah. They're tax breaks. Yeah. And I can go into more detail on that if you want me to. That's why tax lawyers cost $1,000 an hour. Good ones. Yeah. All right. Next up, Peter wrote, so wow, it's 245% tariffs on China now. Does the U.S. have anything else in their toolkit to throw at them, given China's still not responding? Or would the U.S. start looking at sanctions and blockades? Yeah, at this point, it doesn't matter if it's 240% or 2,400%, right? So it's all just a game right now of negotiations and who's going to blink first. And Trump blinked a little bit first, more than a little bit, right? Last week on Wednesday, when the Trump administration said, okay, let's put tariffs on hold for 90 days, except with China. The reason why Trump blinked was because his staff advised him to, because something very, very scary happened. Let me explain what happened. So the United States has $36 trillion in debt, okay? And the biggest debt holder of United States treasuries, U.S. debt, is Japan. They own $1 trillion, not China, it's Japan. They own $1 trillion worth of debt. 1 trillion divided by $36 trillion is 2.8%. The second largest owner of U.S. debt is China, which owns just over $700 billion worth, and they keep selling it. And that's just over 2%. So what China and Japan did last week was terrifying, okay? What they did was they sold a lot of those treasuries, a lot of them, okay? Enough to move the needle that it drove interest rates up in America. Now, let me explain how that works, right? But let me first of all say the fact that Trump is talking to Japan today and negotiating is a very, very positive thing. It's a positive signal, okay? Now, the way it works is this. So a lot of people don't understand why there's an inverse relationship between bonds and yields. This is crucial to understand. I'm going to explain it in 60 seconds. So this here is a U.S. Treasury bill, pretend one, okay? And for argument's sake, let's pretend this is worth $1,000. So the United States issues debt. They sell it to China or Japan or you, right? And in return, you make $50 on that $1,000 every year. Okay, so $50. Okay, that's like a dividends coupon. $50 divided by 1,000 is 5%. Now, the $50 never changes. Just accept that for now, okay? Okay. And since Japan and China were selling treasuries, just like when you sell a stock, it drives it down. But the $50 stays as is. So hypothetically speaking, if this treasury went from being worth $1,000 to $900, that means the 5%, remember $50 stays as is, goes up to about 5.7 or 5.8%. Because 50 divided by $900 is about 5.7%. $50 divided by $1,000 is 5%. So that drove yields up, meaning interest rates up. And that's terrifying. Terrifying because the United States is about to go into a potential inflationary cycle, which makes sense, right? If imports are more expensive and all the costs get passed on to the American consumer, then they pay more for stuff, right? That's inflation. And when inflation goes up, you have to raise interest rates to offset inflation. It's terrifying. And that's why the Federal Reserve Chairman, yesterday, he was speaking at some event in Chicago where he quoted Ferris Bueller movie. He kind of implied that inflation might be an issue. And he chose his words very carefully. But he basically said that there's a chance that we have to raise interest rates. Now, the Federal Reserve, okay, is an independent body. Okay, it's not managed by the president. Okay, it's kind of part of government, but it kind of isn't. And so Trump is trying to bully him into cutting interest rates. It's an independent body for a reason. Now, what happened was this morning, the European Central Bank cut rates as well because they're worried about growth because of the tariff war. So what's happening is we have the risk of U.S. rates going up, okay, which is scary, and the U.S. dollar going down, which is scary as well. Why is it scary if the U.S. dollar goes down? Well, it's terrifying because if the U.S. dollar goes down, as Americans buy imported goods, those goods are more expensive because those other currencies went up versus the U.S. dollar. And those goods are going to be more expensive because of tariffs as well. We live in interesting times. I think a deal is going to get done sooner rather than later, especially because Trump knows that he won't be able to win the midterm elections. Yeah, I just want peace. That's all I want. All right, next question is from Ray, which is, why would you invest in the S&P 500 ETF and not the Russell 3000 ETF? Yeah, Yeah, it depends what your risk tolerance is. Okay, so if you want to invest in IWM, okay, the Russell 2000, for example, you tend to do it when we're in a bull market, okay, when stocks are doing well. And the reason is because the beta on smaller stocks like Russell, the beta on smaller stocks is usually higher, okay, which means that if the market goes up a lot, higher beta stocks go up more and vice versa. And I can drill down to that for more detail if you'd like me to. Yeah. All right. Next up, I've got Alex. Hey, Alex, that's my godson's name. And my godson, Alex, interned with me last summer. Remember that. He just got a job at Deloitte as well. I'm very proud of him. Okay. Do you have opinions on what would happen to the Canadian economy if there's a liberal win or a conservative win? Yeah. So for those who are not familiar with the Canadian economy on a political spectrum basis, in the United States, the more left-wing, relatively speaking, is Democrat. The more right-wing is Republicans. In Canada, it's the same thing. Conservatives are kind of over here. Liberals are over here. Except because Canada is a little bit more left-wing, it's over here. Yeah. So if conservatives win, expect tax cuts. Expect massive expense cuts as well. If Pierre Poilievre wins, which I prefer. If liberals win, which I think they will, then expect maybe taxes to go up a little bit and just expect services to stay as they are. The Canadian economy will grow much faster if conservatives win. I really do believe it. Now, Mark Carney, who's the current acting, I guess I should say, Prime Minister of Canada before the elections come up, he's a good dude. And I overlapped with him at Goldman 8 million years ago. And he understands finance and economics because he used to be the head of the Bank of Canada as well as the head of the Bank of England. Yeah, let me move on now. Okay. Give me 1 second, guys. Sorry. All right, next question is, I don't see your Silver program anymore, meaning my Silver MBA program. I already have it, but I wanted to recommend it to my friend. Are you still offering it? Or are you no longer going to offer it? Yeah, we're focusing mainly on our 3 newer products, which add tremendously more value. It has the same components of Silver in it, meaning the 500 hours. Plus, you get 30 other electives and tons of other stuff. Plus, in my new programs, the way I'm teaching now, it's more interactive. It's more fun for me, too. It's lonely in here. So what I do is I offer daily group Zoom calls. And that's my new methodology. I could still give you a coupon for that for your friend if you'd like. Just email me, Alex, at support@harounventures.com. Thanks. And I have a sales force. I'm scaling my company a lot, so I have a lot of employees as well. And they prefer not to sell silver. I can tell you why if you want me to. Okay, next up, Javesh wrote, hey, Javesh, when the stock market drops, investors move to bonds, okay, which lowers yields, and that seems to affect interest rates. What's the link between yields and interest rates, and who sets them? Yeah, so I explained the inverse yield a minute ago about that. Now, if you want to monitor exactly how interest rates work in every single country, I'll go there very quickly, okay? And whenever you see the Federal Reserve chairperson speaking, everybody is on pins and needles and they're listening. Same thing when the Bank of Canada speaks, the Bank of England, as well as the European Central Bank, ECB, which cut rates this morning, the Minister of Finance in Japan, etc. It's crucial you pay attention to what they say. The reason is because what they say determines interest rates, okay? And then they eventually change interest rates if they need to. That affects all of us. Because if interest rates go up a lot, that means that your mortgage rate for your house is going to go up a lot as well if you don't have a fixed mortgage. If interest rates go up a lot as well, the market's going to go down. Why? Because if interest rates go up like crazy, people are going to be like, you know what, man, I'll just keep my money in the bank and earn interest. And I won't invest in stocks. Like things got so crazy with inflation back in the early 1980s, around the Carter administration before my favorite president ever, Ronald Reagan, was elected. Okay, and that's why I'm in America. I love Ronald Reagan. I love everything that he stands for. But what happened was inflation was so high around 1980 that the Federal Reserve of the United States, Paul Volcker, God bless him, he raised interest rates to close to 20%. And that was to fight inflation. And what that did was it kept everybody's money in the bank. And nobody wanted to buy stocks. Heck, if I could make 20% in the bank or close to it, Why am I going to take risks in the economy? And there were no great IPOs. It took until 86 until Microsoft and Oracle went public. That's the fear. The economy will grind to a halt. Now, let me show you interest rates very quickly here. Okay, so what we're going to do together is we're going to go to a government website called treasury.gov. Okay, and there's Secretary Bessent, who I am convinced told Trump, hey, put a 90-day pause on tariffs, please. So I'm going to show you the data here really quickly. Okay. All right. So what happens is the government sets short-term interest rates. And I'll explain this very quickly. So let's go to the current month right here. All right. So right here, and let's go to the current day. Okay, great. All right. So the government sets short-term interest rates. Okay. So the government sets these rates here. Okay. And it's 4.35%. Okay. And then what happens is the market sets long-term rates, the 30-year. Okay. So if you have long-term rates higher than short-term rates, it's a normal yield curve, and that's healthy because that's telling you that the economy is going to be so good in the future, the government's going to have to raise rates. So anyway, let's move on now. I lost about 10 viewers there. It's like a game for me. It's fun, man. I love this. All right. All right. Next question is, how do you see quantum computing growth stocks playing out in the future, like Rigetti, D-Wave, Long Q, etc.? Yeah. So it's really hard to find pure plays in that sector. You mentioned Rigetti. There's also D-Wave, Ion Q, quantum computing, and a handful of others. But it's tough because there's larger companies that are dominating that industry, like IBM. Microsoft has a piece of it as well as Alphabet, meaning Google. And they actually make chips as well, and pardon me, their own motherboards and other things as well. So what I would do is this. I would go to I would probably go to the annual report of any quantum computing company, okay? And in the annual report, the 10K, which you can get at sec.gov, I would search for the word competitor or competition and find out the names of those companies. Then what I would do is I would do investment research on those as well to find out if there's any pure play. Yeah. And what a lot of people do, you see them do this on the internet, is they'll do a teardown. They'll take a product apart to see what the components are. And so what I want you to do is you don't have to do a teardown, but find people who do teardowns on quantum computing products, or at least talk about what the components are, and look at the supply chain to be able to invest in any of those companies individually. Yeah. It's tough to find pure plays at this point. Let me know what you find though, please. Thanks. I like the way you're thinking because 5 years from now, quantum computing is going to be more relevant than it is today. Yeah. And if I worked in the hedge fund industry right now from a semiconductor investment perspective, I would be all over that right now. Yeah. Nice. Smart. All right. Give me 1 second here, guys. Well, there's tons of questions. And if I can't answer all the questions live, I do daily small group Zoom calls with my MBA degree program students. If you're interested in learning more, just look at that thing at the bottom here. Yeah, thanks. All right. Next up, Caroline. How are you? Caroline's one of my MBA students. Wrote, good morning, Chris. Good morning to you too as well. Je vais faire la classe matinée ce matin. Okay. What are your thoughts on Nvidia? How do you see it in 5 years? Well, I think AI is going to be more relevant in 5 years. Who is the quintessential number one market player in that sector? It's Nvidia. Is the founder still running the company? Yes. Do research on it yourself, please, though. Using that 100-step template I showed you earlier, you have access to it because you're an MBA degree program student. Yeah. Okay. All right. Neo, good to see you. Awes, great to see you. Welcome to the house of Habibi. Okay. And Awes, I think you're from Egypt, just like my dad. My dad's from Sohag. All right, next up, Dana wrote, I want to know more about how to customize VR to aid in visualization goals and stimulate the brain to achieve them. I have a business plan idea. I would like to further discuss it with you, MBA thesis. Yeah, why don't you do this? If you want to talk to me about it or somebody on my team, you can just go to my website, which is harounmba.com. And at the bottom here, you can just click on book a meeting. Now, I don't ever recommend anybody start a company ever. Please, I'm begging you, unless you write a business plan. And in my MBA degree programs, what I do is I have a venture capital bootcamp. And we use this template here where I ask you tons of questions about your company Okay, you answer the questions below: competition, go-to-market strategy, financials, etc. And then what comes out of that is your business plan here. Okay, as well as investor slides. You can raise money. Don't ever use your own money. Always use other people's money. I've humbly raised and managed over $1 billion in my career. I've made mistakes, but I've been humbly successful as well. I will help you with everything. Yeah, write a business plan first. Thanks. Okay. Be careful with VR though, okay? Because the problem with virtual reality and augmented reality as well is it's a very expensive market to get into, because the install base is very low. There's only like 15 or 20 million VR headsets out there. It's been a loser product for Apple as well. And I looked in that industry. As you know, I like to take a lot of risks. And so what I did was I did this weekly MBA degree, this weekly call a couple of years ago using VR, the metaverse. Remember that term? Didn't age well. So let me show you what that looked like. So I'm going to go here to mbametaverse.com, which is a website I bought, right? And what we did here was all the students joining that week. What they did was they joined me here in a metaverse, right? And you can set up VR as well, so that you don't have to wear headsets. And so everybody just kind of uploaded, like a lot of my students on the call. Somebody was Ryan Reynolds, I guess, uploaded their image here for free and all that. Somebody pretend they were me, which cracked me up and scared the crap out of me. Okay, let me move on before I lose it and laugh. All right. Next up, Sanjay wrote, hey, Chris. Hey, Sanjay. And congratulations. I think you just graduated from the May program. The classes started last May. You wrote, when does this trade war thing end? Yeah. I think it will dissipate. I think we've seen almost the worst of it now. What would make it worse is if there's geopolitical tensions in terms of Taiwan. That's what worries me the most by far. Yeah. Really does. So in 1989, in Tiananmen Square, we were lucky that CNN had a television crew because we saw the uprising with Tiananmen Square. Well, today, 1 billion of these things are in China. And if there's any sort of civil unrest because growth slows in China, it'll hurt China more than us. So that could lead to, and the way to get, if we go back to the early 2000s, after 9/11, Bush Jr.'s approval rating was 90%. So read between the lines there. That's what worries me. I pray for peace. Let me move on to more happy thoughts, though. Okay. All right. Next up, Sanjay wrote, also tell me for Carson Levitt. Yeah, Carson Levitt was my mentor. He hired me at Citadel, Pequot. He's a good friend of mine as well. And he was also George Soros' right-hand man in 1999. And he made $1 billion in one stock in 1 month. I'll explain that in a second. So you wrote here, Carson Levitt. How did he help George Soros in the last quarter? I must have mentioned that in some webcast years ago. How did he turn around? Yeah, so I'll explain really quickly. So George Soros is very good at macro investing, meaning currency investing and stuff, right? He made $1 billion in one day by shorting the British pound. He also made $1 billion in one day by shorting the Thai baht. And I can explain how he did it if you want me to. He's not a very good investor in stocks, right? He also leans a little bit too left for me. Now, what happened was, so Soros Fund Management, big hedge fund in New York City, they were down 15% in the summer of 1999. And that was a big deal because the market was up huge and he has a little bit more of a value bent. So what he did was he hired my mentor, Carson Levitt. And Carson Levitt used to also, he worked for Peter Lynch as well at the Fidelity Magellan Fund. He hired Carson Levitt in the summer of 1999. And Carson got the fund from down 15% to break even by December 1st of 1999. And then Carson made $1 billion in one stock during the month of December of 1999. And his investment, he keeps it really simple, right? This is the brilliance of Carson, who is a lot like Warren Buffett. Just keeps it simple. He was walking down Fifth Avenue. This is how he told me the story. And I'm gonna dumb it down, right? He's such a good guy. I love him. But he was walking down Fifth Avenue and he said, I saw more and more people with these things. And I thought to myself, what's in them? Well, back then it was a Qualcomm chip and everyone was talking about WCDMA, et cetera. So he invested in Qualcomm before they got into the patent-only business. He invested in Qualcomm, ticker QCOM, and you can look at the filings and you'll see he did. And he made $1 billion in Qualcomm in the month of December of 1999. Yeah, it was brilliant. Yeah. And he got the fund up a bunch as well, of course. All right, next up, Kindle wrote, AI is all the rage today. What themes would you recommend looking at past it? Autonomous driving supply chain, for instance. Is it in the early adopt stage, in your opinion? Yeah. So it's tough to invest in that, aside from maybe investing in Tesla. If you want to invest in autonomous vehicles, for example, what you can always do is you can look at the Tesla 10K annual report and do a search for risks and suppliers and components. You might be able to find something there. Okay, look at the entire supply chain. Yeah. Aside from that, I'm very bullish in AI. Whenever I invest in any thesis, I always ask myself one question, like I mentioned earlier. In 5 years, is this secular growth story going to be more relevant or less relevant than it is today? So in 5 years, AI is going to be much more relevant. So I'm a fan. I don't like chasing stocks, though. I like buying when everybody else is freaking out, which we're almost there. And I will back up the truck and buy stocks. And I've started to nibble already. Let me show you here. So I will buy, and I recommend, and I put my reputation on the line here. So what you do is you go here and you look at the VIX. Okay. So the VIX right now is so low. There's really not much fear out there. When the VIX gets to above 70s, I don't care what happens, you buy. Okay, no matter what, you buy. So in, I think it was April of 2020, it actually got above 80 intraday. You can't see it here. You buy. People were freaking out then. They were freaking out to the extent that the future price of oil was negative $30 or negative $40. It was crazy. People were throwing out the baby with the bathwater. The same thing here. In the fall of 2008, when we were within 24 hours of bank machines not working, the VIX got to above 70. Now, last week on Monday, the VIX, I think it was last week on Monday, the VIX got to above 60. For me, the telltale sign of going all in is if the VIX touches 70, and I hope it does, because I'll be buying. Now, you'll see that the VIX is down today, so fear is down today right now. Yeah, so it's actually down quite a bit. So there's not that much fear out there in the marketplace. That's right. There's not. In fact, the markets right now are at the same level they were in the first half of 2024. But I don't give a damn. Why? Because I don't care about the path of stocks or investments. I care about the destination. I can sleep at night because of that. Yeah. All right. All right, give me 1 second. Ben wrote, the new course that's said to be released soon. How long will it take to come out? And is it going to replace your 100-step investment Excel file? No, it's going to be additive. Yeah. So it's coming out later this year. I'm publishing a lot of other stuff first, though. It's coming out very soon. Let me show you very quickly, okay? It's going to be unbelievable. I'm partnering with a buddy of mine named Gary. He's one of my former platinum students, MBA students. He's a former investment banker, CPA, and all that stuff. So no, it's not going to replace the 100-step template at all, right? Because this is not really going to help you too much with forecasting and coming up with target price. It's going to help you with the analysis process, okay? And I can go into more detail on this if you want me to. I'm using tons and tons and tons of examples, real companies, Nvidia, Supermicro, as well as Berkshire. I'm using Disney as well to explain balance sheet and all that stuff. It's fun. And then with the income statement stuff, I'm using Tesla, but I don't know if this is going to piss people off because everybody hates Tesla right now. So I might replace it. I don't know. No idea. Yeah. But I don't have a job. I have a passion. I live for this. Yeah. All right. Let me see here. And I think somebody just donated money. Oh, thank you, Andre. You didn't have to do that. $10. Appreciate that. And that donation, I will make sure that it goes directly to the schools we're building. Okay. And so I'm currently building a school in Kenya. I was there, I think last October or something. These are my students, board advisor from Udemy, Marvell. And then I finished one in Rwanda a couple of years ago. So that's what the use of proceeds. That's why I do what I do. Yeah, it's not about the money. Yeah, thank you. So Andre wrote, you should invest your money in higher return on investment vehicles like stocks and entrepreneurship, then do real estate. Real estate, even net of tax benefits, is a safe, low ROI, old man's game. Youth equals growth focus. Thank you for that. I appreciate it. You got a lot of likes as well. Yeah. I would say that, so the earlier you can buy real estate, the better. And let me show you why. Okay, so let's do a very quick exercise together that is going to blow everybody's mind on this call. Let me go to my real estate template here, which is only available to my MBA degree program students. And I'm going to go right here. Okay, so let's say that you spend $2,500 per month, okay, on rent, okay? And let's say you rent for 50 years, okay? So I'm going to go this times 12 times 50 years. So that means that over 50 years, you're going to spend $1.5 million. And let's think that you think that real estate's going to go up 9% in the long run. And I would argue 15% because you get the tax benefits for renting out investment properties, and you get to deduct depreciation, and you can deduct an unlimited amount of interest on your mortgage, right? If you own investment real estate properties in every country. Now, this amount here at a 15% return, it's going to be worth, wait for it, $345 million, right? It's just the future value calculation, right? Right here. And you can take a screenshot if you want to look at my math there. Yeah. Okay. All right, let's change camera angles. Let's try this one here. It's a beautiful day today, man. Yeah. That's the outdoors there. That's where I am. So I got a couple of Japanese maple trees here. We just built out this deck here as well. We're putting up a pergola. That's a new word my wife taught me out here as well. And we just planted about 6 new redwoods as well, so I don't see the neighbor's house. Yeah. All right. Okay, so Sanjay wrote here, Chris, how come you owe more than you make with options? Yeah, and that's a follow up to a question that I answered earlier. So when it comes to when you say you, it's just generally speaking. So when it comes to options, okay, so if you buy a put and you buy a call, okay, and if you buy a put and the stock goes down, you make money. If the stock goes up, you just lose what you pay for the put. If you buy a call, okay, and I think a lot of people should be looking at 3-year leaps right now for calls for your favorite stocks right now. If you buy a call and the stock goes up, make a fortune. If it goes down, you just lose this much. Now, if you sell, meaning you underwrite, kind of like you underwrite an IPO, if you sell a put or a call, and it doesn't matter who you sold it to, but somebody else that bought a similar product from somebody else decides to get out of that position, you might be accountable. And some people say there's a 10% risk of that, to the extent that you might owe way, way more money than what you sold it for. And that's called a random assignment. And it's something that the CBOE has been doing for years. And it's terrifying. Green screen is not working that well. Let me move back here. Okay. Next question is, the options course is an elective in the MBA. Yes. And you can go to FA44 in your curriculum. That's Finance and Accounting Semester 4, Class 4. It's 30 hours of option stuff I teach you. Yeah. And what I'll do in the background is I'm going to show you what it looks like as I answer your question. Take a second to load. Let me try green screen mode here. Okay, good. It worked. All right. Yeah, so the options, yeah, it's an elective. And all the shorting things and how they work are in the options section. Yeah, I explained shorting from scratch as well in a ton of detail in that elective. Now, here's what it looks like. Okay, so there's tons of spreadsheets I create for you. Okay, and I explain everything option-wise using tons and tons of different props. You know how I like to teach with Lego stuff like this. And then I create one-page report for you, and I teach you 35 different option strategies from scratch. Yeah. And there's 3 ways to value options. There's the binomial pricing theorem. There's also the Black-Scholes, which you should never do because it doesn't account for dividends. And there's also Monte Carlo simulation. I teach you all that stuff too. So whenever you look at an option, okay, and you calculate it, the option, you use the binomial pricing theorem, okay, and this will all get populated here. And each one of these cells, and I've got 10,302 cells that I created here, okay, and there's no macros in this, okay. Here are the cells, right? It's really, really complicated. But if I were to zoom out, you'll see that the way to calculate an option price is to use the binomial pricing theorem. And so I have 10,302 calculations here. This tree is massive. Okay, let me go back here. Okay. All right, next up, Matt wrote, hey, Chris, hey, Matt. It's my son's name too, my son, Matthew, my middle child. Yeah, who just joined a fraternity. You wrote, what do you think of the private credit market and the securitization of personal loans or BNPL transactions? Not a huge fan. I don't know as much about it as I do about equities, but it's a very illiquid market, right? And so if you want, I can talk about credit default swaps and other sophisticated products in more detail right now. But the problem with a lot of those products is they don't trade on an official exchange, right? Like a market, like NASDAQ, New York Stock Exchange, etc. So what that means is it's between you and another party, and quite often you have to rely on an investment bank to set that up. Whenever my voice fades, which happens sometimes, so I talk a lot, I use this product called Clear Voice. Use this as well for interviews, please. All right. Almost better. It's getting better. Good. All right, I'm back. All right, next question is Larry Ellison, who's the founder of Oracle, very smart man. I've seen him present before. I've invested in Oracle over the years, massively long and short. Their headquarters were here in Redwood City, close to where I live. If you want to learn more about him, there's a great book called Soft War, okay, which is written by the editor of The Economist. And the reason Larry Ellison let him write that book is because he said, I'll let you write it, but I can put footnotes in every page if I want to. So there's a couple sections that are pretty funny where Oracle, where in the book Soft War about Larry Ellison, there's mention that Oracle could not penetrate the apps market and that a guy named Ray Lane, decided to quit. And Larry Ellison added a star, an asterisk, and said, that's BS, I fired him. So it's a lot of fun. So check that book out if you want to. And we do a lot of case studies in Oracle as well in the MBA degree program. I know that company incredibly well. She wrote here, Larry Ellison is a tough guy. He doesn't age as well. He's like 80. It's amazing. Yeah. He never went to fancy schools. Yeah. I think he went to undergrad for a while in Chicago. Yeah. And he's the only guy in the top 10 richest people who didn't go to a fancy school. A lot of them dropped out, as you know, like Zuckerberg as well as Gates from Harvard. And I can talk about what's going on at Harvard right now if you want me to. He's trying to cheat death. I like him. Yeah, I'm a fan. I'm a fan. He's tough to work for. And a lot of my clients, a lot of my friends have worked at Oracle. It's an extreme type A personality company. It's a sales focused culture. And because of that, it's tough to work there. Okay. But because of that, a lot of great startups come out of Oracle, more so from Oracle than any other company I know of. Okay. So you've got Salesforce.com. Mark Benioff started the company. I met him a number of times back in 1999. He was the youngest vice president in Oracle history. You've got Dave Duffield, who founded PeopleSoft, or Soft People, I used to call it. Tons of people. You've also got NetSuite, which Oracle bought recently, yada, yada, yada. A lot of great startups come out of there. And I try to cheat death as well. So what I do is I biohack a lot, okay? And as I mentioned, we are all 26 years younger than we think we are. And as I mentioned, many people in this call are going to live to make it to 150. So I try to consume lots of liquids every day. I get 20 to 30,000 steps every day in this office while I'm creating content, which I love to do. Let me show you this. And what I'm about to show you, I promise you can help to extend your life. Okay. And I'm going to show you a couple things. Talk to your doctor and all that crap so I don't get sued. Right. All right. So what I do is I have a treadmill. Okay. And I bought plenty of these things. You can get these things for just over $100 on Amazon. It's a life changer. Okay. And so what I do is, and it elevates a bit too. It's pretty cool. And what I do is I get 30,000 steps in this way as well every day. And you actually work smarter and much faster this way as well, because you're feeding your brain and your heart oxygen and all that stuff, and you're getting rewarded in real time. It's kind of like when you were younger, the first hour of each day when you used to exercise, or pardon me, used to study, was way more productive than 10 hours at night. It's the same thing. So every day is a 100-hour day for you. Try this, it works. Now, a lot of people say, well, how do you type, Chris? Well, what I do, you're gonna see a little bit of mess on my desk here. What I do is I bring this up here. I wear my Apple Watch in my pocket so I can count steps, okay? And I get my work done this way. I also biohack a lot in terms of nutrition, tons of vitamins and herbs. I take tons every day. And I learned this from Ray Kurzweil, who is the VP of Engineering, Head of Engineering at Google. He's a biohacker as well. I take his supplements, which I humbly think work really, really well. So that's my secret. That's my secret. I stay young at heart as well. And I have the same maturity I did when I was 15. And y'all know when GTA 6 comes out, you ain't going to see me for a month. I'm just going to be playing. Yeah. Okay. Okay, next up, Digital Talisman wrote, how would you collaborate with a company to create a branded product and not have them simply say, hey, great idea, thanks and goodbye? Yeah. So whenever you meet with somebody, you got to always, and I'm going to quote Dale Carnegie, arouse in the other person an eager want. So understand that people are usually motivated by three things in business. They want to make more money. They want to get promoted. And they want to enjoy what they do. So in that case, I would certainly articulate how a co-branded product and partnership will help them to make way, way more money. And you ought to write a thorough business plan first, and I have templates for that. To learn more, book a call with somebody in my team, see the link in the description of this video. So always think about it in terms of helping them. It's the same thing with when you go to an informational meeting. You want to help them. You want to be additive as much as possible. And I promise you, this will help you materially with your career if you have a give mentality. There's a great book called Give and Take. I'll summarize it for you right now. The richest 1% of people in the world are givers. I'm not just talking about money, okay? I'm talking about their time. The middle 98% are takers. They're avaricious. Most people are selfish. They're like, why are you helping me? And the bottom 1% of people, net worth-wise, are the beautiful souls that choose to be poor and help people, like Mother Teresa, who's my hero. Hollywood, please make a movie on Mother Teresa. That's good. So why are the top 1% of people in the world wealthy? Yes, some of them cut corners. Some of them are jerks. I get it. But a lot of them are givers. Now, what does that mean? I don't mean giving money. I mean giving your time. How can you give your time? Well, you can mentor people in your company. You can mentor your kids, which of course I do. You can mentor, I don't know, your younger cousins. You can mentor people that reach out to you over LinkedIn. Why is that crucial, and why will that help you? Well, first of all, I'm going to get religious here. Giving you'll receive, it's prophetic. It's been true since the beginning of time. Also, if you mentor people, when one teaches, two learn. You're reminding yourself of what your DNA / blueprint is for success. Okay. Sanjay wrote, Meta's going to sell Instagram and WhatsApp. I'll take a look to see if that press release hit. I do know that, okay, so generally speaking, Meta and Alphabet, Google, they're both monopolies, right? Or oligopolies. They have too much power. And historically, those companies would have been broken up. But for government geopolitical reasons, they have not been broken up. Now, Meta knows it's just a matter of time until they're broken up, right? And so it used to be called Facebook. They rebranded it as Meta, right? Thank God they didn't say Metaverse. That's a loser name. They rebranded it as Meta because Meta is kind of a holding company for Facebook, Insta, WhatsApp, etc. The same thing with Google. Larry and Sergey, they're smart as hell. They renamed the company Alphabet several years ago. Why? Because they know eventually the company's going to be broken up into two different departments. YouTube, Google, and maybe one other. Okay. Now, YouTube and Google are the two biggest search engines in the world. Makes sense the government would break them up eventually. But for national defense reasons, they've not done so. Let me take a quick look here to see if news came out on Meta. Okay. And if you're in my MBA program with daily calls, I can always do daily answer questions about everything daily like this. Meta. news. Not yet. Not yet. I'll be surprised if it happens. And of course, you saw on Inauguration Day, some of the most successful people in tech they gave them $1 million each, and they were there as well. I don't think it's going to happen in the near term. Yeah. All right. But I will say the United States, the Department of Justice has blocked a lot of deals. Meta has tried to buy a lot of very small VR and other startups, and the Department of Justice has stopped those deals. They Heisman them for anti-competitive reasons. And so a way to keep these large tech companies in check and a way to foster innovation with startups is the government is not letting them buy a lot of smaller companies. Yeah. And that's why you probably haven't seen blockbuster M&A tech deals in a little while. Yeah. All right, next up, Vladika wrote, first time I've seen you on the call. Welcome. I hope you join us again. Wrote, hi, Chris. Are you just like me waiting for the VIX to reach the magical level of 70 or 80 and above so we can start buying the best stocks? We don't know the path, but we know the destination in the moment. Yeah. So I am waiting for that in terms of going all in on certain ETFs that have high betas. But I am starting to accumulate. Yesterday, I started buying my favorite stocks, etc. Okay. Give me 1 second just to do a quick check here on my internet speed. Okay, we're okay. All right, good. And I have backup internet here as well. I've got Starlink, I've got AT&T and Comcast as well, which sucks. Company is only as good as its customer service, and Comcast sucks. That's right. Screw you, Xfinity. All right, next up, Manas, how are you? From Calcutta is one of my MBA students. I'm looking forward to seeing you in 30 minutes on our weekly Zoom call for my clients. You wrote, good morning. I hope all is well. The world has changed a lot since we last met. Yes, we live in interesting times. Nothing surprises me anymore. Okay. What do you think of Mexico as an investment compared to Brazil? Both are left-leaning countries. Yeah. De Silva and Shabam. Also, do you think Mexico will gain more due to tariffs as China is using it as a proxy? Yeah, so what China is doing a lot of times is China has kind of been selling a lot of products through Vietnam. This is why they just visited there. Through Vietnam and through Mexico to get to the US, right? Including illegal stuff that the Chinese government's not involved with, but like fentanyl and stuff, right? It is coming in through China. And that's why I'm glad that the United States is monitoring trade at the Mexican and Canadian border, because so many people die every single year from opioids. It's disgusting. Yeah. But I do think that I'm more bullish on Mexico longer term because of its proximity to the United States, because that means there's more influence from a capitalist democratic perspective. Yeah. All right. And Hickey wrote, Chris, which real estate tickers would you recommend? Yeah. So I don't recommend individual stocks per se, but I can show you what real estate tickers means. Okay. Now, when you invest in real estate stocks, okay, there is a rule that 90% of the dividends has to be paid, or 90% of the operating profit has to be paid out in terms of a dividend. Okay. So there's a couple you can look at. My favorite ETF company on the planet is Vanguard. Okay. Always do your own research. It just opened a window in another box. Let me go over here. Okay, so you can take a look at this if you want. So the expense ratio here on this REIT, meaning real estate investment trust, is 0.13%. That means it's pretty good, man. Very good. That means for every $100 you invest every year, you pay $13 in fees. As you can see, the yield here is healthy at 4% because by law, these companies have to pay out a lot in terms of dividends. You can always look at the holdings here if you want to for VNQ, okay, to see what's in it, right? So we have Equinix, which is like a data center company. This is kind of set up like a REIT, real estate investment property, holding a public storage, that's commercial real estate, etc. So you can take a look at this ticker here. Please read the prospectus first, though. Okay. All right, next question I've got here is, how would you prepare for an interview with a CTO of a FinTech company, meaning financial technology company? What would you prepare and what type of questions to expect for an AI leadership role? Yeah. So the first thing you do, and I'll make this a generic answer to apply to everybody in this call. The first thing you want to do is this. Whoever you're interviewing with, get their name, of course. Go to their LinkedIn profile, X profile, and Insta profile, and see who they follow. Okay. And if they follow certain politicians, you know which way they're leaning. Don't ever put politicians, don't follow them though, on your profile, because half the people will like you more than the other half. I don't know what half. And you also want to, more importantly, look for things that they follow that you also like, so you know how to bond before business. So, for example, if they followed golf, you might talk about the Masters and Rory's win. Okay. If they follow baseball, you can talk about Shohei Ohtani, your favorite baseball team, etc. And this is crucial because a rookie mistake in business is this. A rookie mistake in business is you show up and you start talking business. That's not how the world works. It's about relationships first, product knowledge second, bond before business. So in the first 10 minutes you're meeting with the CTO or whoever it is, I want you to talk about what you have in common. Read the newspaper that day, set up Google alerts for the company so you're up to speed on what's happened with that company that day. Go to alerts.google.com. You'll get automatic email alerts when any news comes out in that company. So you can talk about that sort of stuff. Talk about the weather. You know, if it's around Oscar season, talk about movies. Talk about what you have in common. You have to bond the first 10 minutes. Then they'll take control of the meeting, don't worry, and they will transition to the reason why you're meeting. If it's an informational meeting, they might say something like, why are we meeting? But they won't say it like that. They'll say it in a gentle way. Then you're going to pitch yourself. Okay? You're not going to oversell though. Okay? Now, if you sense that in the last half of the meeting, that they start saying positive things about the company and the role, stop selling. Why? Because if you keep selling yourself, you're overselling. And you're selling past the close. And you won't get the job or the sale or whatever it is. Again, if in the last half of that meeting, they start saying positive things about their company, stop selling yourself. Otherwise, they're going to think this. Okay, I like this guy. Yeah, I like this person a lot. Yeah, I think I'm going to hire them. Wait a second. Why do they keep selling themselves? Are they desperate? Am I missing something? I'm not buying. Yeah, so anyway, those are some tips. Now, I also have a product, if you sign up for my services, where I teach you how to answer 400 of the top 400 finance questions in an interview and thousands of questions in any interviews as well. Now, I've interviewed more than 1,000 people. I know it sounds like a lot. That's about one per week for 20 years. I know how to interview people. When I worked at Goldman Sachs, I went through 40 interviews, something crazy like that, to get in. I can help you answer every single question. I'll help you with templates as well. I have templates for everything as well. So for example, I have one-page templates for everything, but I just got some finance documents over here. So for example, this will be one of the templates you bring to your meeting here, okay? I also have templates on tech stuff, HR stuff, operation stuff, etc. Every battle is won before it's been fought. I can teach you how to answer questions in such a way that you know what the follow-up question is going to be. How? Well, keep your answers short. If they ask you a question, answer in one sentence or two sentences max. Then allow for them to ask a follow-up question, because if you tell them everything you know already, you're screwed if they ask for a follow-up. What you can also do, I refer to these as crutch words. Okay, I love teaching with props. Is this. If they ask you a question and you're a bit flustered, you can't remember what to say, then you say, in terms of, or moving on to, etc. And that will buy you time to think. If you're rambling, another crutch you can use is, and the bottom line is. Now, I have plenty of frameworks I teach you as well in my programs in terms of how to buy time and answer questions more coherently. For example, there's the SWOT analysis. SWOT stands for strengths, weaknesses, opportunities, and threats. So if you're asked a question in an interview, to buy yourself time and make it look like you have a structured logic progression, you answer like this. That's a great question. Let me analyze that using a SWOT analysis. In terms of the strengths, which are blah, 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 blah. Moving on to, all crutch words. Moving on to the weaknesses, which are yada, yada, yada. In terms of the opportunities, blah, blah, blah. And lastly, the threats, which are blah, blah, blah. And again, if you're rambling, you say, and the bottom line is, okay. Okay. And if you have, if it happens to be a Zoom interview, I can help you in my program. I teach you everything about business, everything about social media as well. I also set up your studio so it looks just like this. I've done it for many of my students as well. And a great Zoom setup can do more for your career than a great Italian suit will. That much I promise you. It's all about first impressions. Yeah. Yeah. Now, when you're on television and my air conditioner broke down, a bunch of mice climbed into it. It's going to cost like $12K to replace it. I'm not going to go there. But when you're on television, I've been interviewed on television before. There's a makeup crew that comes and puts makeup on you. Okay. Don't be afraid to use this stuff. Okay. And if you're a guy and you never use this stuff, let me explain. Because when you're perspiring, and I'm starting to now, it makes you look a little bit nervous. So you go to the drugstore, okay, or a place like Sephora. I know women are laughing. You go to a drugstore and you ask somebody there, is there any powder that matches my skin? Maybe I'm beautiful. Maybe it's Maybelline. Please tell me somebody understood that joke. Go to a drugstore, ask somebody that works there, I need powder. I want you to match the skin color I have. Then you buy a brush from a place like Sephora, and then you're going to put this on so you're not shining. Put a towel on first, please. I've been doing this for 8 million years. And this runs out really quickly for me because my nose is ginormous. That's okay. All right. And then you put it on here to stop yourself from shining. Okay. Now you don't look as shiny anymore. You can also use other products as well, like I had to use in real time here, called Clear Voice, if you're losing your voice, etc. One meeting can change your life. And I'll make sure that you're armed and ready. Every battle is won before it's been fought. Set up a call with us, and I'll explain how. Okay. And everything we sell, there's a 30-day, 100% money-back guarantee. I have 2 million, humbly. That's a Canadian before they're about to brag. I humbly have more than 2 million paying students in every single country. My return rate is 1%. There's a 30-day, 100% money-back guarantee in everything I sell. Nothing to lose, everything to gain. No risk. All right. Oh my God, Chris, you sound like a used car salesman then. Yeah. Oh, buy cars now before the price goes up. Yeah. All right. All right, let me see. Next question here. Chiba K, how are you? It's been a while. Great to see you again. Wrote, hey, Chris, let's say you've done all the analysis and filled out the template. How do you know if all the attributes of the company are priced in already to know if you should buy? Yeah. Well, what you're going to do is you're going to create the financial statements and model them out years from now. And if you listen to every single earnings call a company has, and you can get access to all this stuff online for free forever, if you think, if you do that, and let me show you exactly what that means, okay? All right, so in this template here, you're going to forecast the income statements, okay? And while you go through this, and let me just minimize these to get a little bit more real estate. But as you go through this, what you're going to do is you're going to right click and add a note to every single cell, okay? So for example, and this is taking a second to close, I think. Let me try it again. Sorry, I think I screwed it up. So if the CFO on an earnings call 6 quarters ago said, R&D as a percent of revenue was higher than usual this quarter at 14%, but our 5-year target is 11%. Then what you're going to do is you're going to right click on the cell here for R&D, for example, and then you're going to put in that note. Who said it and when? Okay, so new note here. Okay, so you're going to write here, CFO said on this date to expect long-term target to be 11%. So the CFOs give you lots and lots of clues. All you got to do, it's so much easier than you think. Just document everything they say on the earnings calls, as well as in the quarterly reports, annual reports, 8Ks, everything. It's so fun to do this. It's like a freaking puzzle, man. It's like playing a video game, you know, like a really fun video game. And yes, I am buying the Switch too. It's easier than you think. And that ultimately will get to your earnings estimates many years from now, okay? And then what you'll do is you'll apply a price target, okay, once you populate all the data here. Okay. Yeah, oh, Manas wrote, China sent planes. full of iPhones to India. And they also sent tons to the United States, and actually even the Switch. So Nintendo, and we do a massive case study on Nintendo in the MBA program, and lots of other companies. But Nintendo has about 35 or 40% of its revenues is the United States. So what they did actually was very smart. They already shipped tons of Switch 2s, which is going to be out in June here, to the United States to avoid tariffs. Yeah. So you wrote here, China sent planes full of iPhones to India, so they could be sent to the United States. Was legally smuggling iPhones to India and Vietnam, so it could be exported to USA. And Trump helped cook with this. Yeah. What are your thoughts? Yeah. I wouldn't be surprised. So the reason Tim Cook is the CEO of Apple is because he is probably the best supply chain operator in the history of the world, right? He was COO, Chief Operating Officer, for years. Yeah, I wouldn't be surprised. Yeah. And India is America's best friend for life for so many reasons. Okay, and 11% of my customers are from India. Largest market is the United States, then Canada. Yeah, and then every other country. All right, next up, DT wrote, there are similar branded product collaborations on the market, but this manufacturer's product line is unique. Yeah. In terms of utility and design, regardless of what you're talking about with respect to cooperating with another company from a partnership perspective, you have to write a full business plan, book a call with my team or myself, and I will teach you how. Yeah, I'll help you with that. Okay. Next up, Chibike wrote, aside from the Wall Street Journal, where do you get your news from? For example, how do you know last week that Trump backed off due to bonds selling off? Yeah. All you have to do is listen to anything the Treasury Secretary has said over the past couple of weeks. And so in the United States, it's tough to get your news that's unbiased. So you watch CNN, the world is ending because Democrats are CNN. You watch Fox News, the world has never been better because it's Republican. So what do? Well, you can listen to both if you want to or watch both, but decide for yourself. I like the Wall Street Journal because it's usually more neutral, except for their op-eds, which I don't read unless it's Thomas Friedman, who writes gooder than I ever will. I also like the BBC because the BBC is a little bit more neutral. And I actually watch on TikTok a lot of news from India on the United States markets, etc. Yeah. It's more neutral. But my favorite way is always this, which I did this morning, and please everybody do this too. Alexa, Wall Street Journal news.
From the Wall Street Journal.
Here's your midday brief for Thursday, April 17th. I'm Alex Osala for the Wall Street Journal. President Trump has lashed out at Federal Reserve Chair Jerome Powell. In a post on social media today, Trump hinted at potentially dismissing the central bank leader as...
Okay, first of all, he can't dismiss him because the Federal Reserve is an independent body. Yeah, I don't think he can. I hope he doesn't. I want it to be independent. And what Trump is doing is he's bullying the Fed chairman into cutting rates. Yeah, just like the ECB did this morning. Yeah. Let me get away from politics, though. Okay. It's hard these days, man. All right. Next up, Hickey wrote, hey, Chris, hey, what kind of investments would you recommend to someone living in Singapore where the cost of living is high? Yeah, it depends on your age and your risk tolerance. If you're young, like say 25, then I would say 75% of your investments can be in growth stocks, not the riskiest stocks in the world, but stuff that has upside in the long run, like a lot of upside, like higher beta stocks, not too high. Why 75%? Because you have so many years to make it back. And 25% could be in lower risk stuff you can't afford to lose. It could be Singapore government bonds, which are highly rated, et cetera, or value stocks. Yeah. And you certainly want to get exposure to other countries as well. Yeah. You don't want to just be tied to your currency. Yeah. But I still believe that I think you could still have a material exposure to U.S. markets in the long run, but you have dollar risk. Yeah. And as I mentioned earlier, if you're going to pick stocks in your portfolio, I don't want you to have more than 20 stocks. And I want each stock to be no more than 5% of capital. And I don't want more than 20% to be in any one particular sector from a risk management perspective. So for example, no more than 20% in shipping stocks, right? No more than 20% in tech stocks, retail, pharmaceutical, healthcare, whatever. Yeah. Okay. All right. Next up, Manas wrote, the future of Lyft. The stock is down 85%. Will it be acquired or go belly up? Trump tariffs have decimated the stock badly. Lyft. Seems like an overreaction to me. Does it make sense for a company to acquire it like BYD? Yeah. Well, first of all, BYD, which makes more electric vehicles than Tesla does, would not be allowed to buy Lyft. Lyft is an American company. As we know, it's similar to Uber. The Trump administration would never allow that. There's no way. But I love to invest in broken stocks, but not broken companies. What do I mean? A broken stock means it's massively oversold. The RSI is 20. A stock that is down 85% in 1 year gets me excited. I would do a lot of investment research on that company to the extent that if I don't think they're going bankrupt, I will probably buy it. But after I complete my 100-step template that I alluded to earlier. And what I would probably do is just back of the envelope, I would take a look at the management team. Is the founder still running the company? Hopefully, yes. Then I would look at something simplistic like a price to revenue multiple to see how much is mispriced versus Uber. I'd look at the long-term strategy of Lyft as well in terms of competing with Uber Eats and other new markets, etc. I would look at geographic exposure, etc. 85% sounds like somebody threw out the baby with the bathwater, unless you think the company is going bankrupt. You got to look at the debt covenants as well, which you can find in the financial notes in the 10K. Yeah. But there's 100 steps to look at before you invest in any stock. Okay, you got to do your own research first. And we talked about this at length earlier today. You use my template here to do investment research on Lyft, which we used to call Pink Mustache, when my buddies led investment rounds in venture capital. Okay. All right. Next question's from Chibike, who wrote Hindenburg Research shut down. Yeah, a couple months ago. Yeah. And they were great at short sales. Yeah. And I did an entire YouTube video on that as well. Yeah. The company said they will release all aspects of their model, but it'd be too much to ask for one of your icon course templates about what they put out. Yeah. So what they do, for the most part, is they look for what are called financial shenanigans. Okay, so they look at a lot of accounting stuff, right? So they see if, for example, so they might look at something like this. I know for a fact they do actually. They might look at liabilities in the balance sheet to see what's happening with deferred revenue. If deferred revenue is declining, that's a big red flag, for example. It means that future revenue opportunities are quite low. There's a gazillion things they look at. I teach all that in my MBA degree program as well. All the financial shenanigans they look at, I'm pretty sure I already have in my curriculum. Yeah. Okay. 245% tariff is breaking the world economy. How will China retaliate? And don't you think China is too calm and cool with him now? China is bringing Asia and the EU close together. They are trying to screw the U.S. What would you say to that? Yeah. I think China has more to lose. And I know it's a controversial thing to say. China is dependent on the American consumer. Okay? If exports to the U.S. grind to a halt, the Chinese economy is going to contract. Now, it's a command economy, and there will be potential, hopefully peaceful, read between the lines, peaceful protests in China. And the Chinese government doesn't want that. So I think that Trump might blink one or two more times, and I think that China will blink a lot at one point in time. Yeah. It's a game of chicken at this point. But I don't think Trump expected China to react the way they did. Yeah. Okay. Next up, Donut Ranger wrote, I made a mistake for 2 consecutive days selling my favorite ETF stock. I'm sorry to hear that. Just think longer term. Just think longer term, okay? The longer the view, the wiser the intention. So when I do investment research on my stocks, what I try to do is this. I love to invest in what I believe are 5x5s. What does that mean? That means a 500% return within 5 years. How often am I wrong? A lot. But if I roll up my sleeves and I do the research and the stock is only up 300%, I'm happy. Plus, when you do a lot of investment research, you won't panic sell at the worst time. And when you do investment research, what comes out of the template is, what comes out of that process, 100-step template, is a one-pager. And here's what I want you to do, okay? And this will, I promise you, save you money, hopefully, in the long run. Let's say you write an investment thesis on a stock using my template, and you get a one-page template that comes out of it. And I used to have hundreds of these things stuck up on my wall. And when I was working in the hedge fund industry, I used to walk around and look at them. And what you need to do is this. Let's say you write a one-pager on a stock today. You love it, you buy it, it's a 5% position. 1 year from now, the stock is going down a lot. And you're like, oh my God, it's going down, I have to sell. What I want you to do 1 year from now is this. I want you to go back to that one-pager, print it out. And I want you to look at it. And I want you to have a conversation with yourself like this. Okay, a year ago, I bought this stock. And I wrote this investment template here. If I had known about the news release that came out today that's making the stock go down, if I had known about that when I first made this investment template for this long-term investment, would I still have bought the stock? If the answer is no, sell it. If the answer is yes, buy more, as long as it's not a 5% position. It keeps you unemotional. Now, a lot of billionaires I've worked for are highly unemotional. They don't get too happy when things go well, and vice versa. You have to keep your emotions in check in business, always. And what I did years ago, when I was at my old house, I lived in Burlingame, or Boringame, California. What I would do is this. I meditated. This is out there. I meditated one time. So that whenever I touched the front doorknob on my house, the second I touch it, all my thoughts about business and stress are gone. It stays outside. Because my house is a shrine to spend time with these guys. And this was evident to me when one day I came home. It was in 2008. I was stressed out because, the markets were falling, even though I was net short. And this guy here, Matthew, he was 3 years old. I came home. I came in the front door, and he ran up to me. And he said, Daddy, did you have a good day or bad day? And if I said, oh, it wasn't the best day, honey, he would say, and he'd walk away. But if I would say, I had a good day, he'd say, yes. And he'd light up like Tweety Bird. He's like, can we play baseball in the backyard? And I don't want to do that to my kids. So every day is a good day. You want to be happy now. You want to put your emotions aside. You got to learn how to keep your emotions in check, especially when investing. Yeah. Don't bring your stress home. It's not fair. These kids grow up fast, man. And by the time your kid is 12 years old, statistically, you've already spent 20% of the time you'll ever spend with them. Yeah. You can't get that time back. Family first, always. Yeah. All right. Next question I've got here. Hey, Rusi. Ray wrote, is it okay if your house is 2/3 of your net worth? It depends where you buy. It depends on the valuation. My gut first instinct would be like, that's okay. But I don't want you to put down more than 20% on your house. Yeah. Yeah, because I want you to have other assets as well. Yeah. But do the math there yourself, please. And what you can always do is this. I'll show you. Okay. So the way that you value a house before you buy it, okay, there's 5 different valuation methodologies. I'm not going to go into detail on it, but I'll show you where to get it. Okay. So there's price per square foot or square meter if you're overseas. There's the gross rent multiplier, the cap rate, cost approach, and net NPV, net present value, which is kind of like DCF. So if you're in my MBA degree program or any of my courses, just take this complete real estate course, Alexa Stop, which is only available on my website. I do apologize. I've got to answer a couple of quick questions here and then move on to my weekly Zoom calls with my MBA students. If you're interested in joining these Zoom calls, just book a call with us to learn more about the product. Or what you can do is this, okay? You can go directly to my website, harounmba.com. And then when you're here, just scroll down to learn more about the products here. Okay, yeah. And I do daily small group Zoom calls now. So my paying students, my new paying students for my new MBA products, they get 7 hours every week of daily group Zoom calls with me. And I help you with everything in terms of your business, investments, career growth, raising capital, whatever it is. I help you. So that's 7 hours every week, every single weekday. That's over 300 hours per year. You also get 500 hours of my MBA degree program content for life, and all of my new electives for life. And you also get many hours of one-on-ones with me, so I can help you with interviewing to get that job, so you can have an immediate return on investment in what you invest with me, and help you to start your own company, whatever it is. Yeah. And there's money back guarantee, as I mentioned. Yeah. All right. Donut Ranger wrote, ETFs like the TQs, is it okay long-term? The founder themselves, did they say it's not for holding so long, so swing? Yeah, I know what you're talking about. So swing trading, I understand what you're doing. It's not like day trading. It's kind of like you take a couple of months. Just be careful with that. Because if you're really good at swing trading, you might make, I don't know, like 10% a year. Who cares though? I want you to make, 50, 60% per year by picking the right stocks and doing your own research. Yeah. And the reason I say day trading is like gambling is because the odds are stacked against you. And the worst thing that can happen to you is you walk into a casino. First time you walk into a casino, right? And you play, I don't know, roulette or something, and you win. I hope that never happens to you. Why? Because you might think it's repeatable. One data point doesn't make a trend. By the same token, if the first time you day trade, you make money, right? You think it's repeatable. It's not. There's too many random things that happen that are outside of your control. As I mentioned at the beginning of the call, too many black swan events. You can't forecast, like what Trump's going to say next. Be long-term focused. You'll make much more money. I promise you. And I say it with love in my heart, as always. Okay. All right, guys. I do have to wrap up this call. There's tons more questions I see here. If you're in any one of my programs, I'll see you on my Zoom call again. I do daily Zoom calls with my students. To learn more, see the link in the description or go to my website, harounmba.com, set up a call with us, and I'll walk you through the program. We have a 30-day, 100% money back guarantee. God bless you guys, and I will see you next week and every week at 8 a.m. Thank you so much. And I always play this short video here. It's going to change your life. That I licensed, and I just paid the annual license fee again for it. It's a Steve Jobs interview that will change your life. Thank you, and God bless.
When you grow up, you tend to get told that the world is the way it is, and your life is just to live your life inside the world, try not to bash into the walls too much, try to have a nice family life, have fun, save a little money. But life, that's a very limited life. Life can be much broader once you discover one simple fact, and that is everything around you that you call life was made up by people that were no smarter than you. And you can change it. You can influence it. You can build your own things that other people can use. And the minute that you understand that you can poke life and actually something will, if you push in, something will pop out the other side, that you can change it, you can mold it. That's maybe the most important thing, is to shake off this erroneous notion that life is there and you're just going to live in it, versus embrace it, change it, improve it, make your mark upon it. I think that's very important. And however you learn that, once you learn it, you'll want to change life and make it better, because it's kind of messed up in a lot of ways. Once you learn that, you'll never be the same again.